Welcome to Talk Tickers. Today, we are deconstructing a really fascinating story, Evolv Technology's third quarter earnings. On paper, they absolutely crushed it, but the stock took a nosedive right after. So what on earth did Wall Street see that the headlines missed? Let's dig in.
And this is the central question, right? You've got Evolv, ticker EVLV, putting up what looks like a fantastic quarter, blowing past all the analyst estimates. But then the stock just cratered. This kind of disconnect is exactly what we're here to unpack.
All right, here's how we're going to break it down. We'll start with the headline numbers and that big stock drop. Then we're going to peel back the layers on the revenue and figure out what was really going on there. After that, we'll look at a pretty big squeeze on their margins and then get into their guidance and what seems to be a major strategic shift. And we'll wrap it all up with our take on what to expect from here.
So first up, let's set the stage with this tale of two tapes. You have the earnings tape, which looked amazing, and then you have the stock ticker tape, which told a completely different story.
I mean, just look at these numbers. On the surface, they were incredible. Revenue shot up 57% year over year, which smashed the consensus estimates by a whopping 27%. They blew past earnings expectations, they logged their fourth straight quarter of positive adjusted EBITDA, and they even raised their guidance for the full year. I mean, by any normal metric, this was a blowout quarter.
But here's what happened. The very next day, the stock plunged almost 9% on some pretty heavy volume. And this was on a day when the broader market was actually climbing. So investors weren't cheering, they were selling and selling fast. The big question is why? Well, the answer starts when you look a little closer at that revenue number.
And that brings us right to the heart of the issue, the quality of that revenue beat. You know, experienced investors know that not all revenue is created equal, and they immediately started digging into the components of that big number. Okay, so 70% of Evolv's revenue was recurring. That's the good stuff, right? The stable, predictable income that investors who love software companies really prize. But the real story, the thing that caused that huge beat, was hidden in that other 30%. That non-recurring slice grew by a staggering 254%. That is what was juicing the headline number. And here is the tell. On the earnings call, management themselves basically guided analysts to a completely different number. They said, look, while the headline growth was 57%, a more, quote, normalized view of the real underlying business growth was actually closer to 30%. And that gap, that's where the market's concern was living.
So what was driving that extra growth? Well, about $7.5 million of it came from things that were one-time or non-recurring. Things like a massive contract, some IP license sales from an old product, and even some short-term rentals. Now, these aren't bad things to have, but for investors who are valuing this company like a high-growth software business, they just aren't the high-quality, repeatable subscription revenue that justifies a premium valuation.
But you know, low-quality revenue wasn't the only red flag waving. Investors also zeroed in on the company's gross margins, and this is where the story gets even more complicated.
Just take a look at this. The adjusted gross margin fell from 64% last year all the way down to 51% this quarter. That is a 13 percentage point drop year over year. Now, for a company that's pitching itself as a scalable, software-centric business, a margin collapse like that, well, it immediately gets the market's attention, and definitely not in a good way. On the call, management pointed to three main reasons for this. First, there's a big strategic shift in their business model that's causing some temporary pain. Second, they're dealing with higher manufacturing costs for a new product that just hasn't hit full scale yet. And third, there was a $3 million one-time hit from some inventory adjustments. So it's really a mix of big strategic choices and some operational hiccups. Now, despite this pretty messy quarter, management used the call to frame all of this as part of a deliberate strategic pivot. What they're arguing is that they're trading some of this near-term pain for a much healthier business model in the long run.
And the CEO, John Kedzierski, he really put a fine point on it with this quote. The goal is to make annual recurring revenue, or ARR, the primary growth engine of the company. That is the holy grail for any software as a service business. And he's basically signaling that 2026 is the year this transition really starts to pay off.
And to show that they're serious, they actually raised their full-year guidance pretty significantly. They're now projecting higher revenue, better EBITDA margins, and, this is really key, they expect to be cash flow positive in the fourth quarter. This is them signaling that, yeah, the quarter was messy, but they have a firm grip on the underlying profitability of the business.
So here's the trade-off they're making, and they're being very explicit about it.
To speed up the shift to a recurring revenue model, they are intentionally pushing off $5 to $10 million of revenue that they could have recognized in 2026. Instead, that value is going to be converted into long-term, high-quality ARR. So the crucial point here is they are choosing a slower headline growth number next year in exchange for a healthier, more predictable business for years to come.
So, what does this all mean for the next earnings call and beyond? Let's put all the pieces together and frame the bull case versus the bear case for this stock.
Okay, the bull case is pretty clear. Management is making a really savvy, long-term pivot to a more valuable SaaS model. Underlying demand is strong, they've got a backlog of nearly $300 million, and they're about to hit that cash flow break-even point. The bear case? Well, it's that this was simply a messy, ugly quarter. The growth was inflated by one-time items, the margins are collapsing, and they face enormous execution risk as they try to navigate this really complex transition.
So, for the next call, here's our take. We do predict they will hit that cash flow positive goal in Q4. However, we expect the stock to stay pretty range-bound, let's say between $550 and $650, as the market really takes a wait-and-see approach. The story they're telling is compelling, but the execution risk is high, and for that reason, we're rating the stock market perform. Plain and simple, they have to prove that this pivot actually works.
And as always, this analysis is for informational purposes only. This is not financial advice.